I understand this is the lecture of macro and finance. So, I should start when I was a graduate student. When I was graduate student at Harvard in early 80s, one of my advisor was Olivier Blanchard, and he asked me, what do you want to work on? And I said, I want to introduce banks and financial friction into macro. And he said, that's not interesting. Moreover, you cannot do it. So was the early 80s. So if graduate students try to do it before the Diamond Dybbuk or Bernanke-Girdler, probably I couldn't do it. And he was right. You cannot do it, actually. So you have to take the timing right, actually. And also, you should listen to your advisor. But at the same time, you don't have to obey, actually. So what I did was the macroeconomics of monopolist competition. That was my plan B. And that's how I complete the thesis and get the job and continue. So you have to listen to your advisor, even if you don't have to obey. That's my first lesson. And this paper is joint with John Moore and Shen Xinzhan. So this is a slightly different style from other lecture because the question is very vague. So start with intangible capital. Lately, getting more and more important for production as well as valuations. And at the same time, one of the key characteristic, unique feature of intangible capital is the continual effort of the key workers, key engineers, are important for developing as well as maintaining the productivity, intangible capitals. So then, how do you finance this kind of investment? This is a very vague questions, and you don't know where you start usually. And then, what I try to teach you or tell you today is start with a vague idea here, like an intangible capital, how to finance and what's the characteristics. And then try to come up with a little example first. And so to isolate the ideas. And then after you tried a bunch of examples, you formulate the models. And during this process is a lot of try and error, actually. Typically, John and I and Shen-Xin, we tried more than 100 examples before writing down the model. And then once you settle the model, you keep trying another 100, actually. So you keep trying and until you hit it. And then sometimes people said, where did you get that model? And I said, we try a lot. And the trick is you try to erase all the trace of your try and error so that nobody can figure out where you got it. So that's my trick. Okay. And one of the key elements is that these key workers may not be cannot commit to provide the effort to maintain the intangible after investment. How that limited commitment affect the financing, especially horizon of external financing. So basically, the unlike tangible capital, you can liquidate relatively easily. Intangible capital, you cannot rely on collateral value so easily. So therefore, you have to rely on future cash flow. But the problem of future cash flow is unless you maintain, it doesn't come out. And moreover, every period, key worker wants something to continue to maintain. So that will affect the horizon of funding. So, and then how this funding horizon interact with aggregate dynamics as well as plant dynamics, so dynamics of the individual production units. So that's the questions. And do you see the questions? And then I will come up with a little example, as I promised. This is the example after we tried a few or many, and this is the example. So suppose you put together a building together with general fund, we call goods, to construct the plant. Plant is the tangible capital, production facility. And during this investment, also this engineer who involved in this investment acquires a human capital. That is intangible capital. And you can think this human capital is acquired through the learning by doing, through the investment. And the typical learning by doing is usually learning by productions. But actually here, this is a learning by investment. And when you look at Ken Arrow's seminal paper on learning by doing, he uses actually learning by doing is associated with gross investment, not the production, actually. So we used the Ken Arrow style learning by doing to explain this. Okay. So to finance investment, you can sell the ownership of the plant. Okay. So plant is a tangible capital you can sell. What you cannot sell is a human capital. You cannot enslave yourself. So that's the constraint. See? And so if engineer keep working on it and keep maintaining, continual effort is important. So you don't want to miss the maintenance. And if engineer keep maintaining using his human capital, then output will come out, YT plus 1, YT plus 2, and YT plus 3, and so on. But if the engineer missed the maintenance, then it's gone forever. So that's the little example we are going to start with. Do you see the environment? And the difference between the a one-to-one matching is actually this one. So engineer right now is there, as well as plant owner who own the plant, and they are matched today. But the next period, engineer can work for somebody else, some other plant, or plant owner can hire a new engineer. So match is not constant. So today it's one-to-one, but the next period you can go for somebody else. And therefore, this is not like about Elon Musk. Elon Musk is a unique guy. And maybe without him, the Tesla doesn't work that well, or maintenance is not going well. But here is more like lots of engineers, computer scientists, or data scientists, or the software engineer. They are the ones who is maintaining the productivity of intangible. So this is not about the specific individual. It's about the lots of people, basically, who is capable for the maintenance as well as developing. Okay, so then what is going to happen? Example we are going to think is right now, engineer and the plant owner is watching over each other's, and they are going to bargain over the wage this period. And this is a Nash bargaining, but it's not the same as a regular Nash bargaining. This is the surplus for the the surplus for the plant owner. They have to pay W, but you can maintain, you get the VT plus 1. And typically outside option is there, but if you don't maintain, it's gone. So this minus 0. So that's why this is the surplus for the plant owner. And what about the engineer who is working? This period, you get the WT. Next period, you can find the job very easily. And the typical job matching model, you have a continue to match versus the unemployed. But here, you don't have a gap. Basically, you can find a new job very easily next period. Therefore, the surplus for the engineer is just today's wage. So if you do the maximization of a W, you can see the W, today's reward to the engineer is the 1 minus theta fraction, bargaining fraction of continuation value. And today's value for the plant owner is output minus wage plus continuation value. But when you plug in this W over here, you can see the next period, only theta fraction of output belongs to the owners. And 2 periods later, theta square fraction is on. And you can see the future return is not so reliable for the plant owner or outside financier. So financing is basically engineer initially investing and sell the plant to the owner. But the plant owner knows engineer's help is needed for maintenance. And every period, engineer wants the 1 minus theta fraction of continuation value. That means the long future, distant future return is not reliable for raising the funds. So that makes the plant, so basically the funding horizon short. So despite the plant is lasting a long time, but you don't rely on the distant future returns. So that's the feature of the intangible capital and the limited commitment of the engineers. And this doesn't mean therefore the funding horizon is short because the plant owner derived the value largely from near future revenue. And to further distant into the future, the larger share of the revenue goes to the engineer. You see the theta goes to the owner, but 1 minus theta goes to the engineer. But 4 periods later, 1 minus theta to the 4 powers goes to the engineer. So engineer's share is growing, and while the plant owner's share is declining. Yeah.
I wonder to which extent is this a feature of intangible capital only? For example, to which extent does it only apply to intangible capital?
Yeah.
For example, if you have a steel mill and you have nash bargaining with a union, this is very much tangible capital, but you would have a similar setup, right?
The problem is without continual effort, it goes. So steel mill is still there. So for example, one period, they can stop. And then you can start again next period. So of course, the starting up is not an easy thing, but nonetheless, this part is different. Like intangible capital, if you miss the maintenance, it's gone. And a lot of intangible has a feature like that. Yes.
And also like for the union from Gary, Indiana, it would be difficult to move to other steel mill. Like for the labor union members, it would be difficult to move to other steel mill.
Yeah. Ours is actually don't have any friction here. Basically, the engineer can find a job easily next period in a different place. Yes. So, but the problem is the maintenance itself is efficient. At the end of the day, engineer is going to maintain, and the output is coming. There is no unemployed engineer neither. But the short funding horizon means at the beginning of investment, at the time of investment, and the investing engineer cannot raise enough funding per unit. And therefore, their investment may be too small. So the possibility is underinvestment, not missing the maintenance afterwards. So, but this little example tell you the funding horizon is relatively short comparing to the technological horizon. But at the same time, there is a possibility of the underinvestment. But it doesn't tell you what determines the bargaining power, theta, where this theta come from, and how this embed into the macro model. At the end of the day, this is the macro finance. So you want to make it to be not one by one or the bargaining model. You want to embed into the equilibrium model. And so we need the structural model. So you see so this is the example stage. So then you start writing the model. And here we start with the small open economy. The advantage of small open economy is the interest rate is exogenous. And homogeneous perishable goods, consumption goods every period. And you can use it for investment purpose. And then continuum of agents. So, and log utility, the Yuri and Marcus often use log utility. It's extremely convenient. And so we use that too. So, and each agent sometimes have investment opportunity. We call them engineer. Sometimes not. We call them saver. So, and they switch the position time to time according to the Markov process. Okay, at each date, engineer E can jointly produce the plant and tools. Tool is the human capital. And from the building and goods. This is a constant return to scale production function. So investment function. Use the goods and building to come up with plant. And we normalize initial productivity to be 1. And then tool, you get the 1 unit of tool. So we call it the E tool because of this tool belong to the engineer. So, okay, it's a human capital, basically. And engineer can raise the funds by selling the ownership of the plant. This is like equity financing. You sell the ownership of the plant, but the engineer keep the tools because of this is a human capital. You cannot sell. And here the unlike initial example, match between the engineer and the plant owner is flexible, even this period. So previous example, I said match between the engineer and the plant owner is 1-to-1 right now, but the next period they can change. But here we assume you can choose anyone. So plant owner can hire any engineer, and the engineer can work for any plant owner. So that's the competitive maintenance technologies. And the key restriction is basically the engineer cannot pre-commit to work for less. So suppose since you have a competitive market, the wage is the determining competitive level. and you cannot work for less than this competitive level. So this is like at the time of investment, in order to raise more fund, is telling the plant owner, I'm going to give you the discount maintenance service. But the problem is next period comes, the market is competitive, and the engineer can work for somebody else. And so they will get the competitive wage. And this condition is sometimes called the non-exclusivity constraint in contract literature. Basically, they can trade behind the back of the planners. And you cannot work for less than competitive wage. That's the constraint. That's the only constraint, actually. So in this model. Do you see that? Okay. And at each date, owner of the plant with productivity Z, initial productivity is 1, can hire any number of the tools together with engineer to produce as well as maintain the productivity. The technology start with Z productivity and hire H tools and engineer. What you get is output is proportional to plant-specific productivity Z times aggregate productivity A. So that's the output. And the next period, plant some fraction depreciate. So lambda fraction stays, but the new productivity is Z prime, which depend upon today's productivity and the how much engineer you hire. So this is actually the heart of the model. So heart of the model has two. One is this, you cannot pre-commit to work for less. No exclusivity constraint, that's the limited commitment. This is the technological counterpart for the maintenance technology. And this says if your H is 0, you don't get anything next period. So you cannot miss the maintenance. Yeah?
If we have a competitive market for engineers, could it be possible for us to tell the bargaining story behind that?
Yeah, I will relate to the bargaining story, how it's related. Yeah. So this one is competitive market. And the competitive market is much more convenient to do a lot of dynamics and aggregate stuff. So, yeah.
1 minus lambda engineer just die?
Yeah, so 1 minus lambda engineer, basically the plant tool is shrinks. So here the depreciation rate of the human capital and the depreciation rate of the plant is the same here. And this says actually we normalize one building, you get the 1 unit of plant with initial productivity 1, and then 1 unit of tools. It's plant to tool ratio is 1 to 1. And then this one says if no plant stops, actually the plant to tool ratio continue to be 1 to 1. And when you do that, actually the productivity start with 1, H is 1 per unit of plant, next period is 1. So it's like basically we are normalizing the investment technology to generate enough tool to maintain the productivity forever. And so that's the technology. And this part is something called the roundabout technology. And so basically the productivity depends upon tomorrow's productivity depend upon today's productivity and maintenance. But when you keep doing this, eventually cumulative effort of engineer is everything. So that's we call roundabout technology, following the Ben Babel, Austrian guy. Yeah.
Just a clarificatory question. You said that you assume that an agent at one point in time can either be engineer or
Yeah.
sailor. Now, my question is there a reason why it starts with like engineer raising funds? Because in my mind, it would be like the plant owner is the one who's trying to arrange funds to, employ human capital. But like, why is it that it starts with engineer?
Engineer. So the technology, best definition of technology is engineer is they have an investment opportunity. So they can invest like this. And then once you acquire the human capital or tools, you can use it for maintenance. And I will tell you under what conditions engineers will sell the entire ownership of the plant. And I will tell you need the conditions, yes. So this is the technology.
Yeah, I think it would the story would actually fit quite well to entrepreneurs, right? Like you said, Elon Musk is not maybe the perfect example, but in the case of Tesla, it is literally the case that, or you could say that the firm is quite dependent on him, right?
Yeah.
And so once he leaves, he can just found another firm or do something else.
Yeah. You can do so. In this sense, the match is not specific, but the maintenance is needed every period and you have to keep hiring engineer in competitive market. And then where the building come from, we assume they supply by foreigners. We can have a construction industry, but then where the profit goes and that sort of question comes. So we decided to just simply the foreigner is providing the building, but the foreigner has alternative use the building as a parking lot and getting the goods F, and the depreciation rate is still the same as lambda. So in that case, the building price is the present value of parking lot revenue F, and that's this one. And if somebody may know the credit cycle paper, actually alternative use in credit cycle paper is actually decreasing return to scale. So F will increase when the engineer starts using more and the alternative use shrinks. And that will generate more kick in the asset price. But right now we don't need it, so we just say elastic supply of the building. And what is the plant owner's choice? The plant owner can always has an option to stop and liquidate. We assumed you can reverse engineering, so you convert the plant into this plain vanilla building, like a parking lot, and sell it as a parking lot. So this is the output today, proportional to the plant productivity. And the end of this period, after production, the fraction lambda stays, and you can sell it at price Q. But normally you want to hire the engineer at the price wage rate W, H unit of an engineer, and then next period productivity will depend upon how intensively you maintain H. So that's the choice people are going to do. And this is the highly endogenous plant productivity. Some of the industrial organization model, like Hoppenheim model, the individual plant level productivity is exogenously following the Markov process. Here, the plant productivity depends upon the maintenance and age. So it is very and kind of highly endogenous productivity process of the individual. And that kind of economy, you want to think about the planning for owner have to make a plan. If you continue forever, you want to seriously maintain the plant productivity. But if you stop some finite time, before that you stop doing the maintenance. So it starts going down before the shutting down. So these are the different alternative choice once you have this. This is, we are going to mostly work on the perfect foresight, but the plant dynamics is very rich, actually. And then initially, the plant productivity is 1, so they can sell the ownership of the plant at discounted price of the plant with productivity 1 to raise the fund. And then this is a generic budget constraint of the engineers. So they can consume and they do invest. And the investment cost X unit of goods together with the Q value of the price of the building. But the B, you can raise the fund outside. So the gap is the down payment. The plant, the engineer have to raise fund from their own net worth. And of course, the engineer can keep some ownership of the plant. So D is the financial assets, including the open economy 1 period bond, as well as the plant ownership. If you retain fraction of ownership, that's partly this one. So, and then it's financed by the wage of the human capital, as well as the financial assets from last period. And if you have an investment opportunity, actually you increase the human capital like this. And one thing which I didn't tell you is if you happen to used to be engineer, but now you lose the opportunity to invest, we allow the engineer to sell the tools with the instruction. So this is like the human capital, but the transferable. It's like you give the tools with the instruction how to use it. And how much does it you can recover is the replacement cost. So you can sell the old tools to the new engineer with instruction. So therefore, this budget constraint, you can write it down as consumption, acquisition of human capital, and the financial assets is financed by the human capital, including the replacement cost and the financial assets. And this is we can call it net worth of the individuals. And concerning, related to your questions, actually what is the rate of return on investment for the engineer? Actually, if you use the maximum leverage, sell all the ownership, and just keep the human capital, then the cost you need is the investment cost minus the amount you can raise the fund. And the next period, you can earn the wage, as well as you can resell or maintain this lambda fraction of remaining human capital. If that exceeds the rate of return on bond or financial assets, then engineers who have investment opportunity will go to the maximum leverage. And so basically 1 minus beta fraction you consume, but the beta fraction you just invest as much as possible with maximum leverage. But the people who don't have an investment opportunity, you just save in financial assets. That's the individual's behavior. And you can, we first look at the steady state, where of small open economy, the 2 price, one is the wage rate, the other is the new plant price, the B, and then quantity choice to satisfy the market clearing. So do you see the picture of the economy? But these kind of things, even ask what does equilibrium look like? The only way to do it, this kind of economy, is guess and verify. So you don't solve from the first order condition and all these things. You just go for the guess and verify. So what's the simple guess is basically no plant stops. Plant owner maintain forever. And for that, you need the condition which alternative use is not that good. Parking lot is not that profitable. So if you have that, actually no plant owner stops. And the aggregate ratio of tool to plant stays 1:1. Initially it's 1:1, and the depreciation rate is fraction is lambda, so it stays 1:1. And if you put the H to be 1, then productivity stays 1. So therefore, initial productivity stays Z, and also output is just A because of the plant-specific productivity stays at the initial level. And then come back to your questions. Actually, the competitive economy and the bilateral bargaining is actually is the same. When you have these conditions, basically the bargaining power is related to how much you contribute to the next period productivity. This is something similar to Hossios conditions. Basically, this is engineer's contribution to the next period productivity, and this is the owner's contribution to the next period productivity. If that is exactly the same as bargaining power in Nash bargaining, and then the initial example, Mickey Mouse example, is actually the special case of this competitive economy. Yeah.
Is this equilibrium unique in the no stopping equilibrium?
Yeah. This is unique in here, actually. And I will come back. But yes, so then what we can do is basically what is the optimal maintenance choice? This is the choice of the maintenance. So therefore, cost is W. But the gain is tomorrow productivity is higher by elasticity eta. And then next period productivity is higher elasticity theta times eta through the next period productivity. And so actually what you see is that W is the tomorrow's contribution to tomorrow's productivity and the contribution through the next period productivity and to the 2 periods later. So it affects tomorrow's, and then tomorrow affects the 2 periods later productivity, eta theta. And so this is basically the competitive choice of the maintenance. And what is the owner's the share? It's A minus W. But when you look at it, then today entire share is owner's, but the next period eta fraction goes to the engineer, and the 2 periods later, not just the eta, but also eta theta fraction goes to the engineer. So engineer's share is increasing while the owner's share is declining. So this is the picture of the funding horizon. So this is the horizon from date T onward, and then how much futures return goes to retained to the owners versus goes to the engineer. And the engineer's share is keep rising, and while owner's share is keep declining. And that's why the owner can raise the fund only against the near-term revenue, not the distant future revenue. So, and then when you look at this picture, you see the one curious thing is at some point, owner's share is below the parking lot, the outside options. Why don't you stop? That's the one question we had. And the answer is even though owner's share is declining from today's point of view, and when the time goes to T prime, the past wage is sunk cost. So the wage you pay, owner pay to the engineer is already sunk cost. Therefore, this part is gone. So then, as long as the owner's output is higher than wage, they want to continue. So that's kind of the way you can think about the. So basically, this says the engineer's share is rising, owner's share is declining. Since owner's share is declining, owner derived the value mostly from the near-term revenue, not the distant revenues. So that's the implications of this kind of intangible intensive economy where the maintenance is essential. At the same time, the engineer cannot pre-commit to maintain in future. They want the wage every period. And do you see the, okay. Once you derive from the model, you have to squeeze out the implications. So one implication is suppose the interest rate drops permanently forever. This is like an MIT shock. Sorry for MIT people. But, so basically, it's a perfect foresight, supposed to be, but out of blue, the interest rate drops unexpectedly. And so what is the implication of the interest rate shock drop? Typically, when interest rate drops, it's a good news for investment. But how about here? So this is the investment. So engineers' net worth is going up because of the engineer's net worth is this guy. So if the interest rate drops, the Q go up and the W also go up. So the engineer is actually can invest more because of net worth is bigger. But when you look at the down payment, the investment cost is rising because of the Q is the present value of alternative use. And while funding may not be able to go up as much. So looking at this, the F below F is the building price, while the funding is below the this A, B, C curves, so present value. And so what happened here, paradoxically, is the funding capacity, external funding capacity, may fail to catch up with investment cost. So then what happened is temporarily you get the booms because the net worth is going up. This is like a credit cycle issue thing. So net worth go up, everybody is happy and invest a lot. But the problem is the investment cost, X plus Q, go up more than the borrowing capacity, B. And then economy enter into the slow growth, the path. And therefore, you get the consumption boom, but the slow growth path. And the output boom, temporary, but the slow growth. And then foreign debt also go up and slow growth. So I came from Japan. So late 80s, everybody get excited about how rich Japan is. Like Tokyo real estate value is ridiculously high, and everybody say, "Wow, we are rich." But the truth is that we didn't invest. So the value of investment go up because of the value of real estate is going up a lot. But the truth is the fundraising capacity failed to catch up. And as a result, investment starts slowing down. And the engine of growth in this economy is the investment on plant as well as human capital. If that one slow down, economy enter into slow growth. Perhaps the easier intuition is housing market. So think about the recent housing market in the big cities. And the low interest rate or real interest rate, actually the housing market is booming. And everybody said, wow, we are rich. And, but the truth is, it's not good for the newcomers. Like a new youngsters who wants to buy the house, the borrowing capacity, fundraising capacity may fail to catch up with the cost of housing. So then the newcomer failed to come in. And if newcomer failed to come in, eventually economy enter into the slow growth. So that's the implications. So this is one of the example which the low real interest rate backfire for the slow growth. But when I said that kind of things to central banker said, "Come on, get serious. Usually, reduce interest rate is a good news." But the central banker typically thinking about low interest rate for 5 years, followed by high interest rate. If the interest rate is like a 5-year cycle, then actually the funding horizon, external funding capacity go up seriously. Comparing to that, the building price is related to the not next 5 years, but the 30-year interest rate. So the investment cost doesn't go up as much as fundraising capacity. Then low interest rate is a good news. So that's the typical like a medium-term low interest rate. But the danger is the yield curve control. If you do the yield curve control, interest rate is not just low for next 5 years, but the 30-year interest rate is low. This is what the Japanese Bank of Japan did, reduce the interest rate in the long run. Yeah.
So this is your point about 30-year interest rate.
Yeah.
So it's really, even if I just control 30-year, right,
yeah.
and I do it for 2 years, it's still super bad. It's not just about me trying
yeah.
to push interest rates low for 30 years. It's really about
the 30-year interest rate. This is a perfect foresight, so it's the same. But yeah, but the key is the engineers, the fundraising capacity depend upon the near term, while the building is the long term, and that's why the low interest rate, the investment costs go up.
So if
yeah, yeah.
So in your world,
yeah.
upwards sloping yield curve is a really important thing.
Yeah, and it's actually the flat, but it's fluctuating. So if you do the typical 5-year cycle, then the borrowing capacity or fundraising capacity go up a lot with lower interest rate. But when you do the yield curve control, the borrowing capacity may fail to catch up with the asset price, the building price. Then investment can stagnate. So that's the example of low growth with yield curve control. And so this is the macro implication. And how about the policy? It's not easy to design the Pareto improvement policy here. So basically, engineers do not maintain unless paid every period at the competitive wage rate. So that means the engineer's trading history is not easy to keep track for the creditors or planners. So government cannot tell the engineer how much get paid every period. But so because of engineers keep moving around. But engineer keep moving around, but the plant doesn't move around. So even if you cannot identify the trading history of individual plant at the engineer, you can see the plant, how much each plant pay to the engineer. So wage bill. So if you can do that, then you can tax the wage bill to the engineer and use that tax revenue to finance the subsidy. S is a subsidy. So then what happens is you can actually increase this one, S is going down. And then when you do this kind of policy, actually the down payment go down more than the net worth of the engineer. And actually, population-weighted average expected discounted utility can go up. So effectively, what we are doing is the government is acting like a creditor. So they said, okay, I will give you the subsidy at the time of investment, but later on, I will tax on your wage income. And so that if you can do it, you can increase the allocations like that. Do you see? But when you look at this the propositions, I said the alternative use is not that big. But immediately you might say, what about the other case? If the alternative use is very profitable, then this is the high rent case. Yeah.
I just want to understand
Yeah.
if the tax that you're proposing is dependent on the age of the plan?
No, nothing. Just proportional to the wage bill to the engineer. If the government doesn't know how much to pay to the individual engineer, but you can tell how much total they pay. So that's the idea. If government cannot even detect the wage bill of the plant, then there is no way you can improve. Yeah.
Since you're talking about funding horizons and,
Yeah.
and loading up,
Yeah.
I thought you were going to propose something like
Age dependent.
age-dependent.
No, ours is much more crude. so you subsidize at the beginning, and then later on, engineer have to pay the tax through the payroll tax. Yeah.
What do you mean by beginning?
At the time of investment, yeah, and then it's almost like a pre-commit to work less in the future, receiving the subsidy at the time of investment. So this is a case like the alternative use is rather profitable. Then what happens is the plant, not every plant is continuous. Actually, the some plant continues, some plant shut down over time. Actually, so basically here the building is scarce and the human capital is abundant. So then what happens is the society wants to reduce the number of plants. But when some of the plants shut down, number of engineers is higher than 1-to-1 for the plant. So the continuing plant improves. So what you see is the productivity is continuing plant is improving, while the productivity of stopping plant is declining before finally shutting down. This is something industrial organization people like Gurilikas, Zubi Gurilikas and Regev called the shadow of death. So typically the plant before shutting down, productivity is declining. Now, here it's not the exogenous, it's basically skipping the maintenance. And that is the feature of the endogenous productivity. And there is no equilibrium which every plant shut down, then there is no point to start actually. So that's the equilibrium. And you might say, how about idiosyncratic shock and that sort of things, and you can do. So this is the little idiosyncratic shock. What happens is the productivity is higher than critical level. You want to maintain seriously. As a result, on average, you tend to improve the productivity up to this point. While if the productivity is less than that critical level, the daggers, then the plant starts deteriorating before finally shutting down. So that's the plant dynamics. And but nowadays, the macro people, they want the evidence, which is not the comparative advantage of me. So then what happened is neither John Moore or Shen Xin or me are hopeless in doing the empirical work, but luckily we find the Bank of England people, the Angus Furious and Gabo Pinter, they get a very nice data sets of British the business, and then it has a lot of data basically. It's a panel data, annual, and then how do you detect the funding horizon in here? So the way this is Gabo's initial idea. So let's look at the interest rate shock. And so this is the high frequency identification. Basically, the Bank of England has a monetary policy committee meeting, and then the 30 minutes window, and how much the interest rate moves, and how much 5-year interest rate moves versus how much the 1-year interest rate move due to the news of the 30 minutes window. And then the how to think about the intangible intensive and non-intensive. This is the wild idea. Basically, we decided to look at the number of directors relative to employee. And the director looks like important people for the maintenance of the business. And if you have a lot of directors relative to employee, we call it the funky companies, which is basically the intangible intensive companies. Of course, this ratio depends upon the size. So bigger company has a smaller number of director relative to employee. So we divide the 10 size bucket, and each size bucket above the median ratio of the number of director to employee we call funky, and below we call it the non-funky or the regular companies. And then we look at how interest rate shock to the 1-year interest rate and the 5-year interest rate shock affect investment. This is the fixed capital's accumulation over the H period, looking at the growth rate using the Davis-Hartiman style, the normalizations. So here is the regression result, which is so what you see is the 1-year interest rate shock to the 1-year interest rate don't affect much to the non-funky companies. So you see it's negative, but it's not significant. The parenthesis is the t-value. So it's less than 1 is not significant, right? The funky company is react a little bit more to the 1-year interest rate shock, which is sort of consistent with they raise more fund against the near-term revenue. And but look at the 5-year interest rate. You see, non-funky companies react a lot to the 5-year interest rate shock. This is the standard of the investment. Basically, the investment typically react to the long-term interest rate shock, not the short-term interest rate shock. So you do see the significant negative effect of 5-year interest rate rise explained by monetary policy shock. While funky one don't react that much, it's still negative, but the gap is actually significant. So the funky company react less to the long-term interest rate shock, and if anything, they react more to the short-term interest rate shock. This is a kind of suggestive evidence. The non-funky is raising fund against the long-term revenue, while the funky one is near future revenues. So that's the idea we get. Okay, and you might say, wait a minute, when you look at the different size, where the significance come from? Typically, the smaller to medium size. Smaller to medium size, the gap between the non-funky and funky is significant. So non-funky is reacting more to the long-term interest rate shock, 5-year interest rate shock, the funky one. So, and the most of the gap come from the middle one. And there are something strange. The biggest one, size 10, also the non-funky react more to the funky one. Perhaps this is due to the decreasing return to scale. It's if instead of constant return, it's decreasing return, then the non-funky react more to the long-term interest rate shock. But so this is the kind of suggestive evidence, and actually it's not mine. So it's like we are teaming up with these Bank of England people, and so it is the lots of little companies basically. Number of employee in the bottom one, 25% is like 11 people, which is tiny. And the 75 is still 89 people, which is not that big. So it has a lot of small business and reacting to the different component of interest rate shock. So that's we are doing. So, but I guess you see how it starts and how it's developed. And so first we did this little example-ish things, right? And the question is the intangible capital and maintenance is key, but the people who are key for maintaining may not provide the maintenance service in future. How that affect the funding horizon? And for that, we come up with a little example like this. It's like a Mickey Mouse example, but it will tell you why that kind of environment funding horizon is not that long. So they raise the fund mostly against the near term, near future revenue. And so once you do that, then you start thinking about the full-blown model with macro model. And then we derive the conditions and with this one. And the particular example was the coefficient is theta and 1 minus theta. The full-blown model special case was the introductory examples. And then you derive the various implications and get some verify equilibrium, and then so you start. So typically what happens in this kind of things is initially you have something to say, and you have some conjecture to provide the proof. But typically model doesn't want to say what you want to tell them. So try to squeeze them, and the model say, no, I don't want to say anything. And so no matter how you torture the model doesn't want to speak. And that's the usual at the beginning. But then at some point, model starts speaking, basically. And it's not just what you expect. You actually, they start saying something more than you expected. This one we expected, but with this one we didn't expect. Like a low interest rate can backfire the growth. And also related to the different component of interest rate shocks. And so then this one we didn't expect neither. And so the endogenous, the development of the productivity. And then this one is not ours, actually, basically our co-authors. And so you can see the gradual development from example to the model, and the model get bigger and sometimes become more empirically relevant. But it takes time. So the most of the economics, you finding the right model or the right formulation is a trick. So that's you want to do. Okay, we should stop here.
Thanks a lot.